Well, joining me now to break down the press conference, the Fed's moves, all of it, Brian Nick is here. He's a former markets analyst at the New York Fed. He is now the chief investment strategist at Nuveen Investments. And we also have our good friend, Wells Fargo senior economist Mark Vittner. Big day for both of you gentlemen. Welcome to the show.
Good to be with you.
Thanks for having me.
Brian, I want to start with you on this because, you know, you've obviously from the inside out watched the Fed evolve over the last 10 years. Jerome Powell, very positive about the economy. Obviously, unemployment at 3.8% right now. Even the 2018 projections for unemployment below 4%. Do you think that he's being too positive, too confident in this news conference that he just held?
I think we're so used to thinking of the Fed as being in the driver's seat, trying to pull us out of a ditch or get us to a destination. And now it feels like from Powell's statement that they're really just trying to kind of keep us where we are. And that's a bit of a different thing for the Fed. Instead of they're reacting to the data the same way that we are. They're observing that the economy has improved, that inflation seems like it's crept up a bit, but that growth is still very strong. And they're being able to step back a bit from what is normally a more active role and say, we're going to keep hiking, but we're doing this in response to data, not because we think there's a destination toward which we need to move the economy.
Well, I mean, the unemployment story certainly was a big one, Mark, but also the conversations about the yield curve and that flattening of the yield curve. You know, it actually came into a place during the statement in the news conference that we haven't seen in 11 years. And what that means, a flattening yield curve to be, you know, for our viewers, is that investors are worried that inflation's going to be lower and that the Fed's going to continue to hike rates. But he still kept pointing to that 2% target. He seems very confident, yet the yield curve flattening could be a sign that the investors think something else is going on.
Well, there's a lot to be said for the yield curve. I think my biggest takeaway, the biggest takeaway I came away from the press conference and the policy statement was that Jerome Powell is really a plain-speaking Fed chair. He's probably the plainest speaking Fed chair that we've ever seen. And so basically says the economy is doing very well. I mean, that's not usually the language of a Fed chair. Usually you have to discern that from everything else they say. He also went into some specifics on the yield curve of the Q&A and saying, you know, it could be that the markets are interpreting that the neutral federal funds rate or the terminal federal funds rate in the tightening process is somewhere right around 3, which is where the summary of economic projections. You look at the dot plot, and the long-term federal funds rate is currently just under 3%, right around where the 10-year Treasury is. My suspicion is that in upcoming meetings we're going to see that the dots, the Fed's expectations for the long-term federal funds rate, are gradually going to nudge up to somewhere around 3.25, and that'll be a signal to the financial markets that neutral federal funds rate may be a little bit above 3 instead of below it.
Yeah, great for financial institutions, not so great for consumers with their credit card debt and their auto loans and their mortgages. We're going to get to that later on in the show. But let me ask you about something else he said, which I don't think I've ever heard a Fed chair really say this so directly. When he was asked about the effect on growth of the tax cuts. Of course, the tax cuts that we just had, that package. He said, I can say that committee members, participants generally believe fiscal changes, both tax cuts and spending changes, provide a meaningful support to demand. And then he said, it makes sense that if you lower the corporate tax rates, allow for faster expensing and investment, you've got greater investment, productivity, everything is positive. I mean, he kind of endorsed the president's tax cuts.
I think what he said was very clear about was that he thinks this is going to contribute or is contributing to higher demand in the economy. So you put more money in consumers' pocketbooks, you give corporations higher after-tax profits, you're going to get more demand in the economy. What he's less sure about, I think, but relatively optimistic about, is supply. So the incentives in the tax code to invest, if you're a business, to try to increase your average worker productivity, so important when we have a shrinking pool of available workers to squeeze more productivity out of the workforce we have. That's the key to allowing this cycle to run longer and faster instead of it's running into a wall sometime at the start of the next decade.
Yeah, that's a really good point. You know, household spending picked up. We got that news, Mark, out of the statement. That's certainly a boost for consumer spending, that's 2/3 of the economy right there. He also said that long run unemployment rate's going to be 4.5% long run. So, you know, we're at 4%, less than 4% now, but long run. I mean, really, again. But here's the thing. Businesses are struggling to find workers. You talk to any small or large company right now that the head of that company says, I can't find qualified workers. I can't find kids to work at the burger stand this summer. Mark, that's a problem for the economy if these businesses can't perform at full potential.
It certainly is. It would be a limiting factor for us. Our potential growth rate is the sum of productivity growth and labor force growth when you're at full employment, which is where we're at right now. And so the hope is that we're going to get a little bit more productivity growth. It hasn't been in the data, and I think that's why Chairman Powell's optimism was somewhat guarded on that. My hunch is that we're going to see it this year. I think that productivity growth that's averaged 0.7% per year from 2011 to 2016. I think that this year we're probably going to be around 1.5%. Because GDP growth is growing much faster than employment. So that would imply that the productivity growth has in fact picked up. It just hasn't been reported in the data. We should also see more people come back into the workforce. The proportion of consumers that say that jobs are plentiful has risen by more than 50% since late 2016, while consumer confidence is up just 30%. So that's what's lifted consumer confidence. You would think that more job seekers would come into the workforce in that environment.
All right, Mark Vittner and Brian and Nick, thank you so much for being here. Great voices to have as we wrap up that second press conference by Jerome Powell. Guys, thank you very much. Really appreciate it.